9 votes said wait. 3 votes said raise interest rates now. Not cut them. Not hold them for a little longer. Raise them. On July 29th, the Federal Reserve left its benchmark rate between 3.5 and 3.75%. That was the headline everyone expected. But underneath that decision, something far more important happened. Beth Hammack of the Cleveland Fed, Neel Kashkari of the Minneapolis Fed, and Lorie Logan of the Dallas Fed all broke with the majority. Each wanted a quarter-point rate increase. 3 officials looked at the same economy, the same inflation data, the same energy shock, and the same financial markets as everyone else in the room. And they reached a different conclusion. Waiting had become more dangerous than tightening. That is the signal Wall Street heard, because central banks rarely frighten markets with the decision everybody expected. They frighten markets when the vote reveals that the next decision may be completely different. The Fed did not raise rates, but the argument for raising them is now inside the room. This is the Mercer Ledger, and today we are following the money behind the Federal Reserve's 9-3 split. Start with the decision itself. The federal funds target range remains between 3.5 and 3.75%. It has stayed there since December. This was the 5th consecutive meeting without a change. On the surface, that looks like stability. Economic activity is still expanding. The Fed described growth as solid. Productivity and capital investment remain strong. Job creation has kept pace with the workforce, and unemployment has changed little. Those are not the conditions that normally force a central bank into emergency action. But the same statement contained the problem. Inflation remains above the Fed's 2% goal. Energy prices have been pushed around by conflict in the Middle East. Tariffs are raising the cost of imported goods and industrial inputs. Artificial intelligence investment is creating enormous demand for chips, equipment, construction, and electricity. America is still growing, but the price of that growth is becoming harder to control. This is the Fed's dilemma. If it raises rates too early, it risks slowing investment, housing, hiring, and consumer spending. If it waits too long, inflation can become embedded again. Workers demand higher wages to catch up with prices. Businesses raise prices to protect margins. Lenders demand higher yields because future dollars are worth less. Inflation expectations begin to move before the official data catches up. Once that process starts, a quarter-point increase may not be enough. The 3 dissenters were not arguing about a small technical adjustment. They were arguing about the cost of delay. To understand why that matters, remember how the Federal Reserve usually communicates. The Fed is designed around debate, but it prefers to present a coherent public decision. Officials give speeches. Regional presidents describe risks. Governors disagree about forecasts. Yet when the formal vote arrives, the committee often closes ranks. A dissent is a deliberate signal. 3 dissents in the same direction tell markets that the case for higher rates is no longer sitting at the edge of the discussion. It has become an organized position. Beth Hammack, Neel Kashkari, and Lorie Logan represent different regions and different economic constituencies. They did not arrive from one local banking system or one political faction. Their shared concern was inflation. Each preferred to lift the target range by 1/4 percentage point. That would have moved the upper bound to 4%. The numerical change would have been modest. The message would have been enormous. It would have marked the first reversal from the easing cycle that lowered rates in late 2025. It would have told households and businesses that the path toward cheaper money was not merely delayed. It could run backward. That possibility changes financial behavior immediately. The federal funds rate is an overnight rate between banks. Most Americans never borrow directly at that rate, but it is the foundation underneath a much larger structure. Credit card rates react to short-term policy. Auto financing reacts. Business credit lines react. Bank deposit rates react. The dollar reacts. And the entire Treasury yield curve adjusts to what investors believe the Fed will do next. Mortgage rates are influenced more directly by longer-term bond yields than by the overnight federal funds rate. That is why a central bank can hold its benchmark rate steady, while borrowing costs for home buyers still rise. Before this meeting, the 10-year Treasury yield had moved close to 4.7%, its highest level in roughly a year and a half. By the day of the decision, it was around 4.65%, roughly a quarter point higher than at the previous Fed meeting. The Fed stood still. The bond market did not. That is a crucial distinction. The Federal Reserve controls the shortest end of the interest rate system. Investors control much of the rest. If bond buyers believe inflation will remain high, they demand more compensation to lend money for 10 or 30 years. That higher yield flows into mortgages, corporate debt, infrastructure financing, and the federal government's own interest bill. The Fed can announce patience. The bond market can charge for impatience. New Chair Kevin Warsh appears willing to live with more of that tension. Warsh has reduced the kind of forward guidance markets became accustomed to under earlier Fed leadership. Instead of telling investors exactly what conditions would produce the next move, he has argued for a more open debate and less pre-programmed policy. He called the disagreement a good family fight. That phrase sounds reassuring. For markets, it is anything but reassuring. Forward guidance is valuable because it narrows the range of possible outcomes. When the central bank clearly signals its likely path, lenders can price loans, companies can plan bond sales, and investors can hedge with greater confidence. Reduce that guidance, and every inflation report, employment number, tariff announcement, and oilful price move carries more power. Uncertainty itself becomes part of the interest rate. Warsh acknowledged that the retreat from forward guidance may have contributed to rising borrowing costs in the bond market. Markets, he said, are making their own decisions because the Fed has stepped back from trying to influence every move. That may be intentional. A central bank that constantly protects investors from surprises can encourage too much risk. Traders begin to believe the Fed will warn them before every change. Asset prices rise on the assumption that policy will remain friendly. Financial conditions loosen, even when inflation remains too high. By refusing to provide a guaranteed path, Warsh may be trying to restore uncertainty as a form of discipline. But that strategy comes with a price. Families trying to buy homes do not experience uncertainty as an academic improvement in market discipline. They experience it as a mortgage quote that changes before they can close. Small businesses experience it as a lender refusing to fix a rate. Companies experience it as a bond issue that suddenly costs millions more. Washington experiences it as a higher interest burden on a massive stock of federal debt. And Wall Street experiences it as a wider range of possible losses. This is why the 9-3 vote matters beyond the walls of the Fed. It tells every borrower that the era of waiting for the next rate cut may be over. Now look at the inflation problem confronting the committee. Inflation has remained above the Fed's 2% target for more than 5 years. The extreme surge of 2022 is gone, but the final descent has been stubborn. Food prices are nearly 30% higher than before the pandemic. Core goods inflation has accelerated from where it was a year earlier. Prices for computers, software, electronics, and other equipment have added pressure. That last category matters because the artificial intelligence boom is not only a stock market story, it is a physical construction boom. Data centers need land, steel, concrete, transformers, cooling systems, backup generation, chips, electrical connections, and enormous amounts of power. When Microsoft, Meta, Amazon, Alphabet, and other companies invest hundreds of billions of dollars into compute infrastructure, they compete for the same materials, workers, electricity, and financing used by the rest of the economy. AI investment can increase productivity in the future, but building the infrastructure can create inflation in the present. Then add tariffs. A tariff does not arrive in the inflation data with one clean label. It moves through supply chains. An importer pays more for a component. A manufacturer decides whether to absorb the cost or raise its price. A retailer draws down old inventory before repricing new shipments. A competitor with no direct tariff may still raise prices because the market will tolerate it. The effect appears gradually and unevenly. That makes it difficult for the Fed to know whether a recent improvement in inflation is permanent or simply the quiet period before higher costs reach consumers. Then add energy. Conflict in the Middle East pushed oil above $100 a barrel before prices partially retreated. The Strait of Hormuz and the Bab el-Mandeb route remain vulnerable. Energy prices today are still higher than they were a year ago. Oil does not only determine what drivers pay at the gasoline pump, it changes shipping costs, airline costs, plastics, chemicals, fertilizer, food distribution, mining, construction, and manufacturing. An energy shock can spread into the price of almost everything. The Fed cannot produce more oil. It cannot reopen a shipping lane. It cannot remove a tariff. It cannot build a transformer factory or accelerate a data center grid connection. Its main tool is demand. If supply is constrained, the Fed can raise the cost of money until households and businesses buy, build, hire, and invest less aggressively. That is an extraordinarily blunt instrument. It is also the instrument the three dissenters wanted to use. The majority chose to wait. That choice was not necessarily weakness. Producer prices had recently fallen as energy costs eased. Core inflation showed some cooling. Raising rates into a temporary supply shock can cause unnecessary damage if the shock reverses on its own. The Fed also knows that monetary policy works with a delay. Previous rate increases are still affecting housing, commercial real estate, credit availability, and corporate refinancing. If officials react to every monthly move, they risk steering the economy by looking in the rearview mirror. The majority's argument is that patience preserves flexibility. The dissenters' argument is that patience can destroy credibility. That is the fight. And credibility may be the Fed's most valuable asset. The central bank does not control every price. What it controls is the public's belief that inflation will eventually return to target. If businesses believe the Fed will defend 2%, they are less likely to build permanent high inflation into contracts and wages. If bond investors believe it, they demand a smaller inflation premium. If households believe it, temporary price spikes are less likely to change long-term behavior. But when inflation stays above target year after year, statements lose force. At some point, the Fed has to prove that 2% is a target rather than a slogan. Walsh insisted there is no hidden softer target. The committee is not quietly accepting 3% inflation as the new normal. The three dissenters tested that promise with their votes. They effectively asked a simple question. If inflation is still too high, growth is solid, unemployment is stable, and capital investment is strong, what exactly is the Fed waiting for? The answer may arrive in September. By then, officials will have more inflation data, more employment data, more evidence from tariffs, and more information about energy markets. There are three broad paths. In the first, oil prices ease, supply disruptions fade, and inflation continues cooling. The majority is vindicated. The Fed holds rates, and the three dissents remain a warning rather than the beginning of a campaign. In the second, energy rises again, tariffs reach consumers, and inflation stops improving. More officials join the hawks. A quarter-point increase becomes the minimum action markets expect. In the third, growth weakens just as inflation remains elevated. That is the worst combination. The Fed would face pressure to support employment while simultaneously needing to restrain prices. Raising rates could deepen the slowdown. Cutting rates could feed inflation. Holding rates could satisfy nobody. That is how a central bank enters a credibility trap. There is also a political dimension. Donald Trump selected Kevin Walsh after repeatedly calling for lower interest rates. Cheaper money would support housing, business investment, asset prices, and the federal budget. But the Fed is legally designed to make monetary policy independently. If inflation forces the central bank to raise rates under a chair appointed by a president who wanted cuts, the conflict will become impossible to hide. Walsh would have to choose between political expectations and the institution's inflation mandate. The three dissenters have already made their choice. For households, the difference between holding and hiking may sound almost invisible, 1/4 of 1 percentage point. But monetary policy does not stop at the first quarter point. What matters is the path investors build around it. If the July dissent becomes a September increase, markets will immediately ask whether another increase follows in October or December. A single move can reset the expected peak for the entire cycle. Banks then reprice loans using that new path, not merely the first 25 basis points. That is how a small vote becomes a large monthly payment. A home buyer may face a mortgage rate that has already moved before the Fed acts. A family carrying a variable rate balance can see interest costs rise while the original purchase remains unchanged. A business planning a warehouse or factory must compare the expected return from that project with a higher financing cost. Projects near the margin disappear first. The strongest companies can still borrow. The wealthiest households can still buy. The most profitable investments still proceed. The pressure falls on everything that was only barely affordable. That is exactly how higher interest rates reduce demand. There is no switch marked inflation. The Fed restrains prices by making enough purchases and investments fail the affordability test. The same mechanism reaches stock valuations. A company expected to produce profits 10 years from now becomes less valuable today when investors can earn a higher return from government bonds. High-growth technology shares are especially sensitive because more of their value depends on distant future earnings. Banks face another calculation. Higher rates can improve income on some loans, but they can also reduce demand, weaken borrowers, and lower the value of older bonds held on balance sheets. Commercial real estate feels the pressure when buildings must refinance at rates far above those assumed when the deals were signed. The federal government faces the largest arithmetic problem of all. Treasury debt is constantly maturing and being refinanced. When old securities issued at low rates are replaced with more expensive debt, the government's interest bill rises, even if Congress approves no new program. That creates a feedback loop. Higher interest costs increase borrowing needs. More Treasury supply must be absorbed by investors. Investors may demand higher yields to hold that supply. Those yields then influence mortgages and private credit throughout the economy. The Fed does not set fiscal policy, but it cannot ignore the market created by fiscal policy. This is why the long end of the bond market matters so much. If the Fed raises short-term rates while investors are already demanding more to hold long-term debt, the tightening can arrive from both directions. Short-term borrowing becomes more expensive because of policy. Long-term borrowing becomes more expensive because of inflation and debt risk. The economy is squeezed in the middle. There is one more complication. Financial markets are not merely observers of Fed policy. They help transmit it. If traders believe the Fed will remain too patient, long-term yields can rise, and the dollar can move before any official rate change. If markets believe the Fed will crush inflation, yields may stabilize because investors expect future prices to be controlled. That means the Fed's credibility can sometimes tighten financial conditions without a hike, but it can also lose control of the message. Warsh's reduced forward guidance gives markets more freedom to discover prices. It also gives rumors, oil headlines, tariff announcements, and individual speeches more power to move trillions of dollars. The 3 dissenting votes now sit at the center of that discovery process. That makes their vote more than a forecast. It is institutional pressure. They have placed a quarter-point increase on the table. Every new piece of data will now be measured against it. Every Warsh press conference will be examined for signs that the majority is moving toward them. And every borrower should understand what this means. The Fed did not promise relief. It did not signal a cut. It did not even guarantee another hold. It revealed a committee whose patience is breaking. 9 officials said wait. 3 said the waiting should end now. The official interest rate did not move, but the center of the argument did. That movement is what markets price first. The next increase, if it comes, will appear as a quarter point on a Fed statement. Its effects will spread much further, through mortgages, credit cards, business loans, Treasury yields, stock valuations, the dollar, and the cost of servicing America's debt. That is why this was not a quiet meeting. It was the moment the possibility of higher rates stopped being an outside warning and became a formal vote. The Fed held the line. 3 officials crossed it. Now the entire financial system is waiting to see who follows them. This is the Mercer Ledger. Follow the money. Understand the power.